Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically, again, it would be Michael Becker sitting in with me today in the podcast, but he is closing another transaction. So we're fortunate to have James Eng in the podcast with us, also with Old Capital. Hey, James.
Good morning, Paul.
Putting together a team is very important in multifamily. You have an attorney. You may have a realtor that you've done business with in the past. You may have a lender, and if we're honored to be your lender in the transaction, we're part of your team. So usually have about 5 or 6 different team members. But I think the most critical team member in a transaction is your management company. Management companies can make or break your profitability. They can make or break you being successful with the tenants. They're kind of the barriers between the city. They're also a little bit, and they handle the personnel, they handle the accounting, they handle all the reporting in the transaction. They are a very important piece of being on your team. Today in the podcast, we have Brett Zaitoon. Brett is a property management company here in the Dallas-Fort Worth area. He's been in property management for a number of years. We're going to get some of the insights on what Brett thinks, his suggestions to you, get some of his feedback. We're going to kind of pull away the curtain and talk a little bit about property management and what things you should know about. And I'm going to kick it over to James. James.
So Brett and I met about a couple months ago, just walking a property and got to know each other. And now he's running 2 or 3 of the properties that we recently financed. So I wanted to bring Brett in today and really talk about how he got started and really what he's doing today on the property management side. So welcome, Brett.
Good morning.
Good morning. Maybe we'll just start off with how you exactly got into this multifamily.
Yes. So in 2005, my wife and I were actually looking at a different way to invest. We had been doing a lot of the stock market, and we felt that there had to be a better way to enable us to grow equity and to really increase our investments. We started reading a lot of different books from franchising to real estate, and we realized that real estate has a path and a proven track record that we can actually achieve. So we went out, we decided to buy our first single family home in 2006. And of course, we bought another one in October 2006, right when the market was crashing. So we had to learn very quickly how to fundamentally underwrite, understand the value of a property, and move forward. So we decided that we didn't have enough knowledge to really be able to underwrite the deals as accurately as we needed to. So we actually became real estate. We got our real estate license, became a licensed agent, and we started doing BPOs, which are broker price opinions. We then did thousands of these broker price opinions for banks that were looking for either in the foreclosure or to find a valuation of the property itself. And as such, we were able to understand how to value a single family asset fairly quickly. We realized that the single family assets were actually declining quicker than the rents were. People were, being foreclosed on, and people still need a place to live. So the rents, even though they did come down, the actual value of the properties were coming down much more significantly than the actual rents. So we started buying more and more single family homes, and then we were able to renovate them, increase the rents, and we would try to hold a scope of over a year and season the property so that we could refinance the properties out and then take that equity and then go ahead and purchase new single family homes. We ended up doing, real estate owned properties, REOs. We did foreclosures. We bought them before they went into the tax auctions as well. And that's kind of what started us into the multifamily, because what happened is after doing 15, 20 different single family deals, we realized the returns were not exactly what we had thought beforehand because of the carrying costs and some of the other factors that we didn't really scope at the very beginning of this project. So we looked at a way to have a little bit more economies of scale in moving into the multifamily. And in 2011, we decided to move into multifamily towards the end in a 36-unit apartment complex. And it was our first multifamily deal. And that's how we started.
So did you have maybe a mentor or anybody in 2011? Like, who was out there buying multifamily on your team or by your side? Like, that's a pretty big jump.
Well, we didn't. And that was one of my biggest mistakes, is actually that I did not have a mentor, a true mentor during this process. We looked at the entire scope. We kind of moved into, we both have a financial background. And so we were understanding how, the cap rates work, how the multipliers worked in multifamily, where they don't work that way in single family. The comps dictate what the value is. They don't really do a valuation on rent in your NOI and do a multiplier. So once we really understood that aspect of it, we realized that was the next phase and where we needed to go in order to truly capitalize on the type of income we were looking for passively.
So 2011, so 5 years ago, buy your first 36 unit. Talk me through sort of your progression from after that first deal, your next deal, or possibly even getting into the property management business.
Yeah, so we learned a lot on that first deal. The acquisition side was completely different than single family. And, 1 to 4 multifamily contracts are pretty standard. But when you move into a multifamily true over 5-unit complex, it's buyer beware, and you have to have a much different process. We had never signed an LOI when we bought a single family home. We had never moved through and had to negotiate every single point and assume contracts. And so really learning that entire acquisition phase was completely new. We pushed back on items that we shouldn't push back, that we didn't even know we shouldn't push back on, because it's a regulated aspect of, or pushing back on why are we getting prorated rents on this date. And that was just little items that we had to learn and understand that that's part of the multifamily aspect. And it took a lot longer to do it that way. And as far as the kind of the rehab and the management and why we had to start it, it's very difficult to have a property management company also be a financial company and understand the investor's needs and wants. It's easy for them to be a management company, but the end result was we needed a company that understood that the cap rates were compressing and we needed to get that extra NOI at that moment. We needed a company that understood that a unit shouldn't take 4-6 weeks to turn on a basic make ready. And it's because it was a smaller unit. It was difficult to lease out at that point. It had not been turned. And so really the value add component was being neglected, and we weren't able to push rents. We weren't able to get the rubs we were looking for. And so I realized that at that moment, we were going to have to create our own management company to manage our own personal properties.
So on that 36 unit, you had a third party?
Yes, we did.
Property manager?
Yes, we had a couple.
Okay. And then they just weren't getting the returns that you thought you could get in terms of not only timing of the units, but then also the rents you thought that should have been there.
Absolutely. And then the timings of value that we don't always associate with it. But when you have a down unit for 3 months, that's uncaptured rent that we can't go back and collect. I mean, it really hits. It shows on delinquency. It shows on the value when you look at your T12. And at the time, we weren't able to sell on T1 and T3s. It was a T12 aspect. So any type of variance at the beginning was really hurting the underlying value, especially when you realize that the treasuries were moving down and the cap rates were compressing. And now every NOI dollar that we weren't achieving at that moment was having a huge multiplying effect on the backside of having value to that asset.
Okay. So what happened with that 36 unit?
So that 36 unit, I took over management. We were able to renovate the property. About 2 units are left even today, but we've been able to renovate 34 of those over the last 4 or 5 years. We put about $6,000 a unit in, and that was a mistake. Overspending, coming from single family into multifamily and expecting the same exact result of a single family turn in multifamily, and understanding the dynamic between the two and what actually makes money and what doesn't. It's a funny story. We got into the cabinets, and we decided we were going to strip the cabinets. We were going to strip them, and we were going to put new hinges on. That new hinge probably cost more than the flooring, because you had to go through and sand every unit and resand where the hinges connected, reattach the hinges, rehang them correctly. Then, the next time they got painted over, whatever, it didn't matter. So we did all that work, and then it still didn't matter. But it was one of those learning moments that we realized that we had to change our strategy from just a single family turn into a multifamily, more economical turn, and yet still be able to get most of the upside of the rent that we were looking at.
Okay, got it. So after you take over the management of your first one, then how did you keep buying multifamily, or did you start transitioning more into third-party property management?
Well, we bought one more, and at that point, we proved concept there as well. We got a couple of mutual friends that had another gentleman that was having a hard time with his apartment complex. It was a 44-unit apartment complex, and they just got a BPO and broker price opinion on this asset. And they said, well, we're going to lose money. And so they asked us if we could take over and do what we had done to our personal asset at that point. We went through, we put $2,300 a unit in. We were able to raise rents $80 at the time, which was pretty significant. They were under market as well. We were able to also implement a RUB system. And so by the time it got done, we were able to capture about an extra $120 to $130 a unit, prove it out over 8 months. They were able to sell it for an $800,000 profit rather than a loss at that time. And it's funny, once you do that 1 or 2 times for people, like your reputation spreads, and we had a lot of other people coming on. And at that point, we decided to pretty much go into third-party management, and that's where we've been ever since. And we've grown to about 25 different complexes we're managing now, with another 4 or 5 in the next couple months coming online.
Okay, so talk about how people find you, and then also, how are people deciding to use you versus, is it other management companies have failed, or are they getting you when they buy the property right away? Like, how should people be thinking about their third-party property managers?
It's a great question, and we have both. Most of them are on the new acquisition side. We go through, we help with the due diligence, we move forward, and a lot of times I'm actually even called before that happens, and we're going at, and that's how I met you. We were even looking at a property to see if the group that we were working with even wanted to make an offer on, and we will go help with that. We'll also do the due diligence. We'll do a full analysis of every single unit aspect, what we think can help. So not only the due diligence on what is wrong, but what actually it will take in order to increase that value, to be able to do a RUB, to be able to have another $30, $40 a unit by putting in, let's say, instead of the white appliances, putting in black appliances with a backsplash. But we can offer that option, and we can tell you how much we've seen them going for and what we can expect in that market, so people can make an informed decision on what they think the true upside is. We're a little bit different. We're very aggressive with our rents. And when we've been doing a lot of rent surveys for a lot of the banks and people that are asking for them, we find that we're at the top of the market in a lot of the areas. And the reason why is because we really emphasize extra effort to get that extra 3, 5, 10%. And it takes better people on the ground. It takes a little bit better process. It takes a little bit more in-depth review of everything, from all the way from managers all the way to a maintenance person. And it's a little bit more aggressive, and sometimes it costs a little bit more, but you're able to go and move those rents to the top echelon of that market. And we really feel that that's the ability in this market. When people are paying, a very premium for some of these units, we have to be able to move up and push rents in order to capture that extra value for the future value of what they're looking at.
Right. And I mean, we had a couple lender inspections that you were on, and having you on site, walking the units, talking about what the submarket is doing, I mean, gave the lender a lot of confidence in not only the ownership group, but then who's going to be taking over the property. Because, one of the properties we were looking at had a bunch of deferred maintenance and had been owned by an owner for a long period of time. So they had not invested a lot of the money into the deal. So that's a big help. And we really appreciate you coming along and providing your insight into those deals.
It's my pleasure. And a lot of times it can look scary on the outside, or it can have a problem on the inside, but it may not be that complicated a fix. And the other times it may look perfectly normal, but it may be a very expensive fix. And so in certain submarkets, we do have a little bit of scope, and we were able to reference, hey, we already manage 4 or 5 other properties in this area. These are what we've pushed rents to. And a lot of times people say, well, that's a little high, but we have documented proof over the last few months.
Absolutely correct. Is having a management company on site when you're doing inspection, physical needs inspection to the property is very important, just because it gives a sense of comfort, is that you, the buyer, I'm lending you the money, but I'm making sure that that management company knows what the heck they're talking about, because they're the operators of the property. They're the day in, day out people that have direct contact with the customers, the tenants. We want to kind of see what their track record is historical. So we're going to ask for a number of things up front. When we put together a loan, we kind of want to see what their marketing materials are. We want to kind of see what a contract that they use. They'll probably get a lease contract. They have their own contract for the lease. We kind of want to figure out who their vendors are. We want to figure out who they have used in the past for construction people. Do they do their own construction? Are they the general contractor? Do they hire their own crews out in the deal? We kind of want to figure out, a little bit more about them. So we look at about a resume and what they've done in the past. And so having the right manager meet the bank or the lender is critical. So don't forget to get your management company on site with you. Again, if you don't have a management company, you are the management company. And on these transactions, we really want to have you be the asset manager, going out there, finding the new property and securing the investment dollars to put into the deal. But we don't want you, it's okay if you want to, but we would prefer for you not to be the management company attached to the deal. The other thing is, Brett, tell us a little bit about what type of quality of building do you guys manage? You guys manage A buildings, A institutional stuff. You manage the B stuff, the C stuff. Tell us a little bit about where you fit in.
Yeah, absolutely. We manage typically in the C- to B- space. We have a couple B products. We have a couple A as well. But realistically, we're a little bit more in the value add space, being able to take an asset that maybe either have depreciation or have something that's really causing an economic hardship on the property, or a management play, which is what we're actually seeing a lot of times, even on some of these ones that we are taking over from other management companies that have a track record already, is that there's still a little bit of a management play. And not that that's free. It costs money in order for us to have the right staff in place in order to create that extra value. But by looking at a management play, that's one of those ways in this market that we can become ahead. If we have lower delinquencies, if we have higher collections, if we have a lower loss to lease, if we're able to rub back and just change what they're currently doing without even having a capital expense go into that property, that's a true value in this market that we're seeing. And so we typically handle a lot of the more difficult in the C and trying to move it into the B- space or a C+ space from a C standard, or a C- to a C. And so typically that's the market we're in. We're in most of DFW, and we have a lot of secondary markets that we're in as well that have a little bit more upside for when they're buying.
What submarkets are you maybe have a better concentration in within DFW, would you say?
Yeah, absolutely. I mean, we have properties all the way from West Fort Worth into North Dallas, to East Dallas, to South Dallas, but we have a lot of properties as well in Arlington. We have them in Hearst, Euless, Bedford. The cities are difficult to deal with, but they can actually have a really big upside because of the market that is there currently. It's a little bit older market, but it has the ability to push rents and really move that market up in those areas. So we're into those type of markets. We're in South Dallas. We're into DeSoto and Lancaster. So we're into some of the secondary markets as well in East Dallas, as well as North Dallas as well.
Okay, we were talking about sort of mismanagement. When you're looking at a P&L, or even when you walk a property, what are some of the telltale signs of bad management that you see?
Yeah, there's quite a bit, but what we found was loss to lease, the delinquency, and the vacancy kind of wrapped into one category. And I know we all know to look for that, but if you see a big loss to lease and it's not a recent rent increase, so for the last year and a half, you've seen the same loss to lease, a lot of times that means that they've tried to move rents up, but they're still having to actually have concessions, or they're not being able to move their current tenants up to that market. And what ends up happening is you see that that's an inefficiency. Even though the market rents may say $875, they're only actually effective at $700. So when you look at those and you say, well, the submarket says we can get to $900, but you're not just moving $50. A lot of times you're actually having to move $200 from the original $150 that you're not getting, plus that $50. So I would say those three categories in general, I would put those into one category, but that's a quick way to look at those P&Ls and those financials and understand. And I like looking at the T12s. The T12s show a progression of a property. And with that one page, you don't have all the information, but you have enough information to be able to see, are they turning it? Is there a high vacancy, but are they closing the loss to lease? Are they closing the vacancy up? Is the delinquency growing? So are they putting people in that can't pay? And so it kind of gives you an overall health picture of that property, and you can go back in time and see it and see the progression. So I really like that. Another problem that I see is people running the properties too thin. And a lot of people think that that's a positive because, hey, we're really reducing the expenses to the point where we're making a little bit more cash flow. But at a certain point, you're going to be able to actually depreciate that asset by not having enough proper maintenance to even keep it at status quo, much less push the rents. And so a lot of times we walked in, we'll see 100 unit and it may say $5,000 in R&M. Well, at that point, yes, maybe that's physically possible and people are underwriting that, hey, you're only going to have to spend that. But that's not what we see. Once you get in there, we're typically having to fix subfloors, or we're having to go in and fix leaks that have been underneath, or maybe even roofs. And what ends up happening is that number really moves up in order to create the type of asset you want. Because even if it costs an extra $20,000 or $30,000 a year to get your R&M in the correct place, if you don't do that, you could actually lose $100,000, $200,000, $300,000 off that building, off that value, because now you can't get the rents and people don't want to move into something that doesn't had new light fixtures or that has broken stoves and nobody will replace them. So it can be a huge economic windfall if you actually do that, and it can be a huge negative if you don't have the right repairs and maintenance and expenses to built into your property. And really the last thing is the financials. Understanding them, looking at the P&L, looking at the financials, sometimes they don't add up. And we actually see it a lot to where the financials actually don't create an entire picture because they don't know what it means. And the property management company, or they're self-managed, or however it works, it doesn't add up. And so a lot of times that can be a big red flag, because people will say that, hey, we're making $20,000 a year. But when we actually break it down and put it in, maybe they moved items that were supposed to not be CapEx into the CapEx, or maybe they just didn't even understand where the money was going. But a lot of times that can be a huge sign of mismanagement, just not being able to have a clear understanding of the financials, have a general ledger, and be able to account for all the different categories and where the money is going.
That's the biggest fish hook that non-sophisticated buyers get caught on, is a big-mouthed bass. They look at the NOI on an operating statement. They say this property is making $75,000 a year. And then they show it to Brett, who's done 100 of these, eyeballing these things, or even showing the lender, us take a look at it. And it's way off. I mean, they manage the property themselves, but they don't have a management fee in there. The ownership group that's selling it, that guy is a painter, and he's painting his own stuff, or he's maintaining his own stuff. They starve the property to death at R&M, that repairs and maintenance. They don't put any money back into the property. You know, if you squint your eyes, yeah, it probably makes $70,000. But if you take out all these additional expenses that are real expenses, that if I have to foreclose the property and take the property back for some reason, I have real expenses that I have to account for. So that NOI may go from 70 down to 40,000 in a blink of an eye. And so on your team members, again, whether it's your loan officer or your attorney, make sure your property management owns properties in that specific area or in that general area. They can kind of give you an idea of how they run the property, how they run other properties in the area, and have them prove up to you on looking at other operating statements on how they're running the current properties in and around that area. I think that's very important. So you want to pull the curtain back a little bit and see how he's operating other properties in the area. And the other thing is when they're out at the property, they're going to put together a proforma for you, maybe a year or 2 year. And I don't want to see a consolidated proforma from the property management company. I want to see a monthly. I want to see it, January, February, March. I want to see the whole thing when you take over the property or whatever month that is. I want to see what's going to happen. Is it going to be a hockey stick that for the next couple months it's going to be stagnant or stable, and then all of a sudden it starts to move up? And I want to find out if it's realistic. So I want to have him prove up or have her prove up that this is what it's going to be. So I want to see that pro forma written by your property management company. I want you as the owner, I want you to prove it up to me. Before I take a look at the deal, I want you to make sure you've already done your math on the deal and you can tell me that this is the way you see it. But I also want somebody that has some eyes in the market, that knows what's going on. So we want to see the property management company look at the deal too.
I mean, a lot of times, we come across, these Class C deals, 50, 75, 100 units managed by, mom and pop, and the financials just really aren't there. And so in order to get these financed, we're going to the borrower's pro forma, which is typically from the management company. So you've helped us put a couple of those together and have really helped the deal get approved. So appreciate that. So you talked a little bit about, you're really in the value add space. And so let's talk about some of the investments that your investors are putting into these properties to really get the most bang for their buck.
Absolutely. The investors are all over the spectrum on what their plan is. And as a management company, our real goal is to be able to be stewards of their vision to their property. Some people, when I first started as well, I was going to put a helipad on top of one of my apartments because I'd read that in a book that was a good idea to do. But pulling back a little bit and understanding where the value really lies, that's not going to add any value. What's going to add certain values in certain submarkets sometimes are different. But a universal aspect is a good vinyl plank floor or sheet floors where you can have them look like real wood or tile, and you can get different aspects on that. You can get a two-tone paint. You can get a light fixture package for a very economical price that can change the entire look of an entire property. Those are the general items that a lot of people do. Doing a little bit of curb appeal. You're able to sit there and go and take an asset that looks very poor on the outside and trim the trees, move the canopy up, do maybe a granite on the lower level of the front of the buildings, and maybe have a little bit more of a native plant here in Texas, because a lot of these smaller and mid-sized properties don't always have irrigation, but you can still make it look appealing visually. Some people want to paint, some people don't. I prefer, if I don't have to, I don't want to paint it, because that's extra maintenance, that's extra time, that's extra effort that's going to be in that cost, but it can really change the look of a building. So there's pros and cons on that as well. As a non-standard item, one of my gentlemen that had just purchased a property about 6 months ago, he was looking at the numbers and he had a laundry room, and he was upset that we weren't getting the type of money that we were collected. Well, he has individual laundry spaces in each unit. So he was saying, well, how can we capture that laundry income? And so one of the upgrades that we did is we offered a washer and dryer with a certain special that we were having in the property. It was going to cost an extra $35 a month, but we were able to give them washer and dryers. And a lot of people are moving, don't always have their own washer and dryers. And so we were able to capture $35 a month. There's about a 100-unit complex, about 40 of the units we've got under at this point. And those units cost $600. Okay. So you were able to have a year and a quarter, year and a half payback on your initial investment, and then it goes straight on your NOI. Right. And so those are some of those non-standard items that you can put in. A lot of people are going and doing, interiors and exteriors, but there are also certain items like that you can do in some certain submarkets that really work well.
Okay.
Talk to me about how much money, if you're going to go in and rehab a unit, just on the interior of the property itself. Talk a little bit about costs to get that biggest bang possible, to get 25, 50, if it's in the market to get the upgrade. What exactly are you doing, and what's the cost going to be?
Absolutely. So we have a wide range of clientele, and some people put 10,000 in, some people put 2,000 in. There's a really nice sweet spot about 35 to 4,500 though, that you can typically get a nice floor. You can get a two-tone paint. You can get an appliance package on a really maybe a used appliance package, and you can also get light fixtures, and you can get resurfacing of the bathroom and a countertop. Now they're not going to be hard surfaces. They're not going to be really high end per se, into a certain submarket, but at certain price points, with that $4,500 turn, I've gotten $225 in rent in some areas. Some areas maybe you only get $50. It depends, of course, on the submarket like we were talking about, but you can go in there with a $2,000 where you're just fixing, a little bit of the floors and paint and maybe light fixtures, up to granite, slate. We've had people put, 10, 12 a unit just on an interior. But a lot of times you don't see those returns unless you're in East Dallas or Highland Park or some of the other areas. So we typically say if you can look at 35 to 4,500 per turn, and that's just the turn. That doesn't mean that, there's a subflooring issue and now we have to go back in and fix that, or there's a leaking valve, or there's a mold behind that initial drywall that whenever we go in and replace a fixture. But if you look at that metric, we can typically hang in that range, and a lot of times you can get 50, 60, 75, or 50 plus a rub on the bill back on that. So it really just depends on the submarket, and that's really where your due diligence comes in, and understanding where you're positioned in that market. I'm one of those people that if I'm not going to be able to get you enough of a return to make economic sense, I'm not going to tell you to spend $5,000 for a $20 a month rent bump. I mean, when we are going to say, hey, look, we're recommending spending $5,000, but you're going to get $125 plus a rub, or we're going to get $175 on the total. At that point, it makes economic sense. The payback's there, and you're, with the cap rates as compressed as they are, it really creates value in this current market.
I'm a big believer in doing all the right stuff up front, putting all the brand new capital into the deal up front. I know James is the same way. We just don't like it out of cash flow. Get the investors to get the cash flow, but put all the right money into the right things up front. Management companies are so critical of giving suggestions of what's working on their other properties for you on your subject property. And James has the ability to put in a lot of the capital, the rehab dollars, into the loan too. So if we can get on the acquisition plus the rehab dollars, times it by 75 or 80% on the front side, get all your money, make sure it goes into the property, then turn it over to the management company. One more thing.
Well, I cannot agree more with that. That is one of the biggest issues that we see is that when people look at their scope, they say, well, hey, I've got this number and this metric that it's only going to be 3,000 because over the United States, this is what the average is. Well, the economics of scale on those type of units, you may be having a 50 or 70 unit. You don't get those economies of scale when you're looking at that compared to a 300 or 400 or a 10,000 area submarket. So a lot of people come in underfunded. They come in with expectations that they're going to be able to renovate a property for $25 or $300 or for $3,000. And can it be done? Absolutely. But everything has to be perfect. There can be no variances. There can be no subfloors. There can be no walls. There can be no city comes in and makes you put a new box in. I mean, it makes it so that if there is any hiccups, you have to go out of cash flow. And that's probably, I don't want to say the number one, but maybe the number two mistake that I've seen. A lot of times they're not properly capital funded at the beginning, and there's not enough, I guess,
yeah,
reserves.
people that do that. Yeah, people that do that, the property kind of looks like a patchwork quilt. One unit looks like this, one unit looks like that, another unit looks like all different types, and that really shows, I would say, a little bit of piss poor ownership and management of the property, because they're just doing it out of cash flow whenever the property turns. So you have a mixed match of carpets, mixed match of flooring, mixed match of pulls in the kitchen, on the cabinets. You know, it looks terrible. So you have a maintenance person comes in, you want them to understand they may have difficulties trying to figure out how this unit is going to be maintained versus another unit's maintained, and you're sending the maintenance person to Home Depot to find all different types of parts, just killing costs in payroll. James, anything to add to that?
So you said number two issue. What was your number one? Just to not hold people on the edge of their seat here.
Well, I would say just not a clear vision of what they're looking for, and not maybe understanding how it's going to translate from the industry that they have been into moving into these. A lot of the times we get people that are their first or their second deal, and we're trying to help them understand and transition from, once again, like single family homes and going into a multifamily, understand what's the scope. What are we looking to do? Are we a 7-year hold? Are we a 2-year hold? That has a different term in how the management company will attack it. We still will give everything we can and try to make it as profitable each quarter. But if we know all of a sudden in 3 or 4 months you're going to sell, that's a different animal than if we know that this asset's going to be a 4 or 5 or a 6-year hold. Now, in the same sense, as we've talked about, this market is transitioning in some way. Sometimes you can sell and you can change your scope because you can monetize the next 4, 5, 6 years at this moment in time. And so we can handle that adjustment, but understanding what the vision and goal is from the beginning, it prevents mismanagement. It prevents extra resources going in, and all of a sudden we've all agreed that it's going to be blue, and now we change it to green, and then we change it to purple, and then by the time it's done, it's 3 different jobs that should have only been done one time. So those are probably the 1 and 2, and as such, then funding the deal. Well, we want to have granite. We're going to put granite. We're going to put new cabinets in. Well, all of a sudden that bid comes back at $7,000. Well, we're not funded as such as the owners of that property. So now we have to adjust, and then their vision becomes diluted whenever the reality of the budget comes into play.
So vision and upfront CapEx funding. So is there, like, take yourself back maybe 2 years ago, is there a property that, you guys came in, had a good vision, well capitalized, and really able to execute a plan? Any success stories that you can share with the audience?
Yeah, I mean, we've had a lot of those actually, but one of the most interesting and excited success stories that I have is a gentleman came up to me, and he has a little bit smaller unit, and he was having a real hard time with his management company, not being able to even see where his money was going. Every month they were offering him a capital call. He had an asset that had been fairly updated, but still needed some work on a renovation. So he was saying, I need help. I can't get my financials. I can't get statements. They ask for money each month. This asset's depreciating before my eyes. I can't even sell it for what I bought it for. I'm in really big trouble. And we were able to, with his help, create a real vision that he wanted, be able to be the steward of that vision, renovate, put new tenants in. We took it down to 0. In essence, we took everyone out. We put all new tenants in. We got qualified tenants. There is only so much absorption of qualified tenants, and that's another mistake people make. They say, well, we're going to take 30 units down at one time, and that's fine. And we can renovate all 30 units within a month and a half, 2 months. But the absorption rate of certain markets may only be 20, 25% of the total unit complex measure if you're trying to get the right tenant with the right background, the right qualifications, right income verification, and job verification. We've found that we actually did a study, and we found all of our evictions, what was the number one reason why they were being evicted? And we went back through all the metrics. We found out that job stability. most of the people that are being evicted, it wasn't they weren't making enough or they had evictions on their record. It was that they only had a job for under 6 months. And they were either constantly moving jobs or they were losing jobs and they were, reapplying, and that was the stability point. So we build that into our whole system. And so in order to do that, it takes a little bit more time to fill up a property, but we got his filled back up in about 7 to 8 months. And we were able to have him profitable in those 7 to 8 months. He started making money each month. He ended up selling it for a profit. And afterwards, he gave me a really nice recommendation in a letter, but he just sent a personal letter. And that's what meant so much, because he was in a situation where I've been, where I was hemorrhaging money into a property, not understanding where my finances were, not being able to account for the addition, and not being able to understand where my out was. And so I guess that's, to me, the greatest success story, is actually being able to help with our vision of our company and the goals of our company, to be able to help. And he was just a single owner, but we do that for both single syndicates, large syndicates. We treat everyone the same. And that's what made me the happiest in this process.
No, the ability to see through the numbers is key. And then also being able to execute the plan that is given to you is huge. So throw a little bit of a curveball here on this next question, but talk about maybe something that you've changed your mind about in the last couple of years. Maybe there was an idea or a belief that you had and that maybe you changed your mind on in the last couple of years.
That's a brilliant question. And I'm sure it's going to continue to change, because what I've learned is at the beginning, I was very rigid. I was a fundamental investor. These have to make sense in only these little small box. And at the last couple of years, I've seen people be able to find and really earmark good deals in any market, and being adaptable is something that I didn't see as strongly as I needed to. But the people that have been adaptable, the people that have been able to see where the upside is going to be, not just being scared of, oh, this is a very hard market, so we're not going to move forward. Looking at that transition and finding that there's deals in every market, whether they're up, whether they're down, whether the market's sideways, but being able to truly understand and fundamentally underwrite a deal, making it make sense, and then pull the trigger on it. It was something that when I looked at, I was very rigid, where it had to be in these 2 or 3 boxes at the very beginning. But understanding how a market works, I guess that's where 2 or 3 years ago, in seeing where the market was and underwriting things a certain way, I've really understood that there is still value to be had, even in an up market, a down market, a sideways. And I guess that would be the one thing that I've really learned, and I've changed my strategy, is I look for a different aspect and a value. I look for being able to pull in maybe monies from different area and put capital into a different place, and maybe be able to increase the rents, or going into a rub system. A lot of our properties have rubs for pest control now, or admin rubs, or some of these other type of rubs that are creating extra value that 2 or 3 years ago, I didn't think we would be putting those in, but now we need that in order to hit the proformas and hit the numbers that our clients are needing.
Yeah, I think a lot of investors who started when you did, let's say 2010, 2011, they're used to buying Class C deals for 25, 30 a door.
That's right.
And now they're seeing stuff at 50 or 60 a door, and they just can't get around that.
We walked by 14 caps all day long, and in
2010,
2010, 2011. That's a 13 cap. I don't want that. People would be beating it on the door for those. But yes, so you're exactly right. It's adapting what you understand as the norm, understanding the fundamentals, and really being proactive and going out and trying to be a leader in the market rather than reactionary. At that point, when you're a leader, you can go back and you can get those extra values. You can create that extra money. And sometimes it's risky to be a leader. It is. My properties are very high on our rents and what we expect. But because of that, there's also a lot of profitability now that we've been able to build in. So even if they come back a little bit, if there is a correction, they still are going to be profitable. Whereas if we're at that mid-level and we have to reduce at that point, we could go to not profitable for our owners.
Yeah, we've seen the cycle run pretty long here. Any tips sort of if there is a downturn, how people can be prepared for that, and from an ownership perspective, and then also when working with management companies?
If I had a crystal ball, I would be able to rule the world. But realistically, it's very difficult to know when it's going to change. And all we can do, and I've talked to both you and Paul about this as well, and I like to be able to understand the financing arm, because I think that's a critical weapon moving forward in the downturn, is being able to have a long enough term so that you can weather the turn be able to still make profitability because of a good term that they can get through lenders like yourself, and be able to move forward on the next upside swing, that you're still in a spot where you still have the ability to where it's non-recourse. So you have the long-term debt on this. And now you've found yourself in a spot where you can actually ride the storm out. Because if you buy it right and fundamentally, you can still make cash flow even in this market. And a lot of times I see a lot of people with a 4% cash on cash return and a 20 IRR, when in essence it should be 11, 12, 13 cash on cash and a 17 IRR. And if you can get to those metrics, even in a down market, you can still make money.
So a lot of our investors are, first, second, third time owners. Any advice for them when they're out looking for properties and sort of how to get started in this business?
If I could go back, I would find a mentoring group or a person or somebody that would help shortcut my path, my arc to where I was. Because I did a lot of the items on my own and my wife and I did them, we had to learn each mistake as it came. And let's say that there's 100 mistakes out there to learn before we get through and before you're truly knowledgeable about multifamily. A good mentor, a good person may be able to help 70 to 80% of those move through and understand, hey, look, this is the LOI. This is what needs to be on the LOI. We didn't even know what was supposed to be on the LOI when we first did it. So being able to really go through those 70 or 80% of those items, you're still going to have to learn, when you actually own and through experience. But if you can cut those down to a smaller number, what ends up happening is you become a much more educated and successful investor much more quickly. You still have to have the same skill set. You still have to have the same due diligence in the underwriting, the fundamental analysis of a deal. But you can take your time and focus on the very important things, such as creating extra income or creating value, rather than understanding the process. And there's so many different people and groups out there already that I think that that's probably the one thing that I would do differently, and it would be my advice. Understand, find somebody that can help you, and it will really shortcut a lot of your problems moving forward at the very beginning.
All right. What's the best way for people to reach you if they're interested in multifamily property management?
You can email me at Brett, BRETT, Z as in zebra, at Allied, ALLIED, MGMT.com. It's the best way to get a hold of me. I'm out at properties a lot, but I do respond fairly quickly.
Also, too, Brett and I have known each other for how long?
I don't know, 3-4 years.
3-4 years, and I think he's a quality management company. Him and I work together real well. I like the way that he puts together his proformas and kind of has a kind of a pulse on what the market is. So I appreciate him coming in and James coming in. James, anything we should tell the listeners about anything that's coming up in the Old Capital?
I think number one, if you haven't got our white paper on apartment finance, you can send an email to info@oldcapitallending.com, info@oldcapitallending.com. And if you're going to be in the DFW area in September, we're going to be having the
fight of the century
between Fannie Mae and Freddie Mac on September 21st at the Grapevine Convention Center at 6 p.m.
And then also, too, if they like the podcast.
So you can, number one, subscribe. So hit the subscribe button so that you get notified of all future episodes. And then also give us a rating. We prefer 5, but if you could give us a rating, that would help us grow our audience.
Fantastic. Brett, thanks for coming in. James, thanks for hanging out with us. And thanks for joining us on the Old Capital Podcast.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.